I'll start by introducing our speakers here. Chris Concannon. Chris is President and CEO at CBOE Holdings. He joined in 2017 with the BATS acquisition. Chris is responsible for all of the trading businesses, US and European equities, US options.
That's too long, so just stop.
Okay. He's done a great deal. All right. He's responsible for a lot of things, including the BATS IPO.
It's funny how short Farley's is.
But I got into Georgetown.
If you're a Georgetown alum, you don't need an introduction.
No.
That says it all. Tom is the president of the New York Stock Exchange Group, which includes the New York Stock Exchange and a diverse range of equity and equity option exchanges, and all wholly owned subsidiaries of ICE. So with Tom, as I mentioned last year, the important information is he played baseball while he was at Georgetown. And he started all 4 years on the hilltop. As a senior, Tom put himself in the Georgetown single season record books.
Go on.
With 56 games, and 56 games started and 49 walks. He also ranks near the top in the career record books for games played, 193, games started, 187, walks, 121. Should I go on?
No.
Okay.
No.
Okay.
By the way, for the young people, this was the baseball field, right where we are. Unfortunately, it was beautiful, right in the middle of campus, and this was the infield.
That's right.
That's why you made all those games?
It was easy. It was easy.
Yeah. Okay, moving from one Tom to the other Tom, Tom Wittman. Tom is Executive Vice President of Nasdaq, and Tom heads the global equities business at Nasdaq. He oversees global cash equities and equity derivatives. Nasdaq.
That's it. That's good.
Yeah.
And I wore the Nasdaq socks to not be confused with the other Tom.
Those are
Nasdaq
sweet.
No, I hadn't noticed
Okay.
those now that you mentioned it. Yeah.
Those are hard to
cool.
notice.
Those are very cool. Do you have New York Stock Exchange socks?
No, Tom's known for this, and I feel like I want to have NYSE socks, but I don't want to steal his move.
Yeah.
Okay. I'm delighted that all three of these participants and their institutions, their organizations, have been huge supporters of the center. So I want to thank you very much. You've been supporting us for many, many years, and that
Thanks
is
for having us.
terrific. Mark McPeace just spoke, started off, and he was talking about how the London Stock Exchange Group has been transforming itself, and in the last 10 years, how they've diversified regionally, globally, but also in terms of products, and how the exchange is actually now a small part of the group. What's been going on with your organizations? How have they changed in the last 10 years? And also looking into the future, how will they continue to change?
I'll take a quick stab at it from a regional Philly exchange, and it was a deal that Chris and Nasdaq did. Because I think, the way this story goes from history, it probably also fits into the BATS-CBOE story and even with ICE and NYSE. But so the Philadelphia Stock Exchange, the oldest exchange in the US, very small equity exchange, but an options exchange. And we were a member-owned organization. So we transformed from a member-owned organization, demutualized, thought about going public, had a good options business. Nasdaq acquired the Philadelphia Stock Exchange to diversify in a different asset class and a different revenue source. From there, I think technology has been a big driver of continued growth. Nasdaq acquired OMX around the same time, the regional Boston exchange. So it was asset class diversification, but also geographical diversification, different revenue sources, and a lot driven by technology. And I think that if you look at the history, that's one thing that's driven. We're also, we're all global exchanges. We went from, private seat holder exchanges to public companies, all part of public companies now. So that's been a big change in the 15 years.
So that's obviously changed the the governance structure of your organizations. So Tom, what do you expect to change in the next 10 years? Where are some of the changes going to be?
I think you'll continue to see technology drive change. I think Mark may even mention that. I think that's been a driver in history, and I think it'll continue to drive in the future. I think regulation is going to have to be part of driving change as we go forward. Things like MiFID II in Europe, but I think U.S. If we see changes in regulation, that will be something that will change the dial.
Tom?
You know, the New York Stock Exchange, by and large, is the same business it's been for 225 years. So, like, you know, the stock exchange was started.
Same people, too.
Same people, same people. You know, the stock exchange started right at Wall and Broad, and right, George Washington was sworn in, and right at that same time and era, the stock exchange was founded, and entrepreneurs would come to the corner and they'd say, oh, I have an idea, I want to start a business. I need some dough to start the business, and investors would say, okay, well, if I give you the money, how do I get it back? And so the idea was born here in the U.S. It's pre-existed New York Stock Exchange in Europe, but let's just show up every day and trade securities. That's all we do today. We help men and women raise money. They go build their businesses, hopefully make the world a better place, and then we trade their stocks every day. So it's very similar. The difference is, in the earliest days, the days we have records of, and they're spotty, there might be 5 orders to buy or sell stock. Last Friday, which is the last day I got an approximation, we had 50 billion messages that we processed at the NYSE group in all its various forms. And so underpinning that is very sophisticated, complex, and costly technology. So while the New York Stock Exchange does the same thing, it's really done for 225 years, not just the last 10 years. This expensive technology has kind of led us to diversify our business. So if you rise up to Intercontinental Exchange, the parent of New York Stock Exchange has diversified, added new types of products to trade, new futures contracts, to spread that very large fixed base across a broader business set. And then the last area, similar to the London Stock Exchange, which is in the preamble to your question, Rena, last area where we've really invested is just providing more and more data products to customers all across ICE, because the technology is so sophisticated. People are trying to ingest as much data as possible because they're able to actually do something with massive amounts of data now, whereas they wouldn't have been able to 10 years ago. And so Intercontinental Exchange, where it started as kind of an niche energy futures exchange, we're now the largest equities exchange in the world, but we're also a very large player in the provision of data across all asset classes and lots of futures contracts.
Those were great answers. No, I'll start with the changes of the governance structures of all of our organizations. As Tom mentioned, we were all member-owned, member-driven, and you hear a lot in some of the reports and in the press around for-profit exchanges and how those are somehow evil. But if you go back to remember the member-driven, the member-regulated exchanges, those were the things that we all had problems with. So the for-profit exchanges came about because of the conflicts of interest of having a member in the boardroom and a member running the exchange. When we went for-profit, if you look at exchange consolidation, that's really defined the last 20 years has been exchange consolidation. It's because of the competitive markets that we sit in. Whether it's options or equities, we created a market structure that we compete, whether in Europe or here in the US. And that really forces the best technology on the best exchange and the benefits of those exchange consolidations to lower cost to compete more aggressively in the environment we sit in. It's also been among futures exchanges. You know, as much as people talk about vertical businesses of the futures exchanges, they do compete. They compete with each other. ICE competes with CME on energy products, and obviously we all compete with the over-the-counter market. So as I look at the global exchange space, I think that the exchange consolidations that we've seen has defined the last 20 years. The technology that exchanges use is radically innovating. And I think the next 20 years, as I think about it, is the exchanges that we operate keep getting closer and closer to the client. And if you think about TD Ameritrade, you press a button on TD Ameritrade and the order is executed in less than a second. And that's the ability of the client to get closer to where the execution occurs. And I think that trend will continue.
So you've talked about broad trends. Can you give us examples of specific initiatives that you're taking?
Well, Tom has those new socks. That's their new marketing campaign.
That's new. So I guess I'll start. New initiatives. You'd almost probably have to pick an asset class, right? So I'll just go with equities because that's where most of us are in. I'd say Revitalize is a big effort that Nasdaq has going, and it revolves completely around smaller and mid-sized companies not going public. So that's a big initiative. It's not a technology initiative per se, but it's one that encompasses, from our CEO Adina down to everyone in the organization pushing this Revitalize platform. Really, it's looking at a couple different areas that we think keep or create hurdles or keep companies from going public. And it could start with regulation, a little bit of market structure, and then looking at some longer term, we'll call it long-termism. So on the regulatory front, and I think a few of us have talked about this, has been widely publicized, but companies have more hurdles like proxy advisors, certain disclosures that need to be made in order for them to go public. Maybe even Chris has some insights as he took Bats public. I've never talked to him, so maybe just putting him on the spot. But so there's a lot that's got to be done by these companies in order to go public, and I think the small and mid-sized companies have a harder time. Mm-hmm. When it comes to first going out with your filing, there's frivolous lawsuits that come about. There are proxy votes that can be initiated by firms if they hold $2,000 or more in individual stock for a year. So that creates a whole other process for companies to go through. From a market structure standpoint, these small to mid-sized companies, if you look at fragmentation in the equity markets, more and more liquidity and trading happens off exchange. So I think for the small and mid-sized companies, we'd like to see a concentration of liquidity, so restriction of the UTP privileges to form liquidity so the public companies can see liquidity formation on exchange and the companies trade. And then on the last side, there's long holding disclosures. On the short side, there are not, so we'd like to see short selling or short position disclosure. So Revitalize, it's all around listed companies, and that's a major initiative on our equity platforms.
We're doing a lot of the same advocacy. I mean, I kind of think of it when you say initiatives, in three buckets. One, initiatives that we're putting in place just to help our own business and shareholders by providing some new service to customers. I won't kind of do the advertisement for NYSE, so I'll skip over that for the moment. Come back to the advertisement in the next question. Then there's policy that impacts trading, trying to make market structure better. Then there's policy that impacts the listing environment. And the listing environment is concerning. If you look over the last 20 years, the number of listed companies is down dramatically. I think the number approaches 40% if you look in the current 20-year window. But aggregate market cap is up by 3 times. So the average company is now 5 times bigger than it was 20 years ago. And so it doesn't take a rocket scientist to say, well, the public markets are working for a big company. They're working less well for a small company. And that's not a good thing as a public good. What you get is you get companies that are just staying private longer, creating enormous amounts of wealth as private companies. Why is that an issue? Well, my father, sitting in Bowie in Prince George's County here, can't invest in Airbnb. So as they're creating that enormous wealth, you don't have as broad-based an opportunity for wealth creation as you would if you were a public company. And so when I'm coming down to DC, this is a fun visit because I get to come to Georgetown and bring back all the good memories. But typically, I'm going to Congress. I've testified twice this year on exactly these issues. How can we make it easier to be a public company for those smaller companies? Spend time with Treasury, spend time with the SEC. Because I think, and my colleagues at the New York Stock Exchange think it's a fight worth fighting. There is a little bit of wind blowing at our backs, a little tailwind, and it feels like we can get some more of these basic changes, basic fixes, to make it a more friendly environment for smaller companies.
Do you think the Jobs Act has helped?
Yeah, unquestionably. So Rena asked about the Jobs Act. For example, the Jobs Act allowed originally small companies with less than $1 billion of revenue to file confidentially to go public. That's been very helpful because when a company files to go public, actually Bats a great example. Bats filed to go public and ultimately chose not to go public and then came back and approached the public markets again. When they filed to go public, they had to put out their prospectus on sec.gov. I can tell you, I referred to that prospectus many times. Many times. I could tell you exactly how to get to that original S1 because it told me a lot about their business that they otherwise wouldn't have wanted to share with a competitor who wakes up every day saying, how can we beat them? Well, the Jobs Act allowed them to avoid, would have allowed BATS to avoid filing that because they were under $1 billion. Now that's been expanded to all companies under Chairman Clayton, which is something he was able to do with the stroke of a pen, which again is very encouraging. No investors are hurt by that. And companies are, in fact, investors are helped because they're going to get more companies going public. And that's a really great example of government working well.
I mean, I'd add, I think the Job Act has helped, but it hasn't moved the needle all that much. When you think about Airbnb is a perfect example. This company's worth somewhere around 30 billion. We don't really know because it's private, but it's worth almost as much as Hilton International. And Hilton actually owns their properties and real estate. So there's two edges to the stay-private problem. One is, as Tom pointed out, there's a lot of investors that have missed out on the run for these companies. If you remember when Microsoft went public, I think they raised like 150 million. So it was a small company when it went public, and people got to enjoy part of that wealth creation. A lot of the private companies that we see right now, the so-called unicorns, there's 200 and something unicorns now, whereas there was probably only 70 10 years ago. So it's the access to capital which is really the problem. So it's really discouraging to go public. It's kind of painful. You're threatened by lawsuits. You just don't want to do it necessarily if you're the CEO. But they have easy access to capital. And so the VCs are just fully funded and they have been dumping capital into the private market. It also is related to where rates are, right? If rates are an all-time low, close to zero, there's a lot of cash moving around the system looking for returns, so people are getting into these private companies. And so the rich are enjoying the wealth creation in the private, all of Silicon Valley, when you think about the wealth creation there, no retail investor really participated in that.
Yeah, I think that's a major point too. It's the average retail investor in these online broker-dealers that have $30,000, $40,000, $50,000 in their account. They cannot take a shot and own a couple hundred shares of these companies, which they could years ago in the examples of Microsoft and the Amazons and et cetera.
I remember sort of mid-'80s, late '80s, I could go around the world and say, excuse me, only in the US could a Microsoft, a Netscape at that time, go public, up and coming companies like that, but that's really changed. And so it's regulation, market structure, that's making it more difficult for companies to go public, the smaller companies. It's litigation.
Shareholder class action lawsuits, there's been 3,600 in this country over the last 10 years. People are quite afraid of them. Many of those, maybe even most, are frivolous, but very painful for a company to deal with.
So talking about private companies, so we heard from an index provider, FTSE Russell, and FTSE Russell and Standard & Poor's, as you know, have a changing how they deal with companies that have super voting rights. And how do the exchanges feel about that? So Mark would say that they're listening to the buy side, and large institutional investors, they really want to have their voting rights and be able to exercise their voting rights. But exchanges are listing those companies just fine. Is there a tension here? How do you think about it? Why do they think differently about it?
So in general, our listing rules at the New York Stock Exchange are a blunt force instrument, and they're something that we change with great trepidation. We take great care when we do make changes. Our worldview is that we should allow companies to operate their businesses as they see fit, provided that they're well-governed and provided that they're the kind of companies that we want to hold out to retail investors as being well-run and kind of, for lack of a better word, good enough to be listed on the New York Stock Exchange. We don't think we should use our listing rules as a blunt force instrument to dictate governance for listed companies.
Yeah, I mean, we support, their notion to have this separation. So I don't see it as an issue for listing exchanges, but it does feel like it's more on the indexing side that, they've got, different opinions about it.
Do you come under pressure from institutional investors to change your listing rules?
We're asked the question. I give them the answer I just gave. And I think they went and then appealed to the index providers for a different answer.
Is this a good thing for shareholders, for shareholder democracy? Do you worry about it from that aspect, or you'll give me the same answer?
Yeah, no, I think it's good. I think it's a good thing for shareholders to be able to invest in more companies and enabling companies. I mean, there's a lot of great examples of dual-class shares that have created tremendous value. I mean, I think of Facebook or a local company that's done well, Under Armour. These are companies that may well not have gone public, and maybe they were the Airbnbs or the Ubers where they would have created tremendous wealth in the private market. And you have these transformative founder entrepreneurs who have benefited from their governance structure. So yeah, I think it's a good thing for shareholders to have more companies to invest in. And certainly shareholders have a choice as to whether or not they will invest in Facebook or not. And all we ask is that those companies are very clear in their public documents about what their governance is. They're fully transparent. And we allow buy-side investors to institutional investors and retail investors to make their own decisions whether or not they invest.
Yeah, I think it comes down to the last point. It's a choice that the investors can make. And as long as there's transparency about, their voting rights and not, it's the investor's choice, which I think is a good thing.
And remember, there's this entire body of law here called Delaware Law that is governing all shareholder rights. It goes back to how do we make our markets attractive for these companies to even come public? I mean, if we have these voting rights that are a little bit too distracting for the management and the board of a company, they're going to choose not to go public. The problem is these companies have choice right now, and cash is available on the outside, either through debt or through private lending. And why do they need to go public and battle voting rights? So it's just another reason why we could have distractions from companies even coming into our market.
It seems like all three of you sort of agree on this point.
We agree on a lot.
What do you not agree on?
Tom's socks. Really ugly.
They don't match
I
either.
don't know, Tom, you might have a different opinion.
We definitely don't agree on Tom's socks. Yeah, we do agree on a lot. We compete vigorously. It's pretty fun, actually, just how competitive an industry it is. I mean, whether it's, if it's an ETF listing, I'll go into a meeting and I'll hear, oh, Chris was just in the meeting, or Chris
Tom
was
was
just
in a month ago.
Or Tom was in a month ago. Touche. So it's highly competitive, but as policy matters go, I agree with Chris. We actually agree more than we disagree. We work in these exchanges, which are a public good, bringing price transparency to the masses and price discovery to the masses, providing that capital formation is the formative underpinning of the economy. And so often you'll hear in our words and deeds trying to embrace that, trying to make it ever more robust, because it's part of what's made this country so special for the last couple centuries.
You really think it's fun?
I do, yeah. Honestly, I was talking to some young people upstairs, the Georgetown Baker Scholars. I applied for the Baker Scholar Program when I was here, and I was rejected, so I considered saying no to the invitation. But I took a deep breath, and I
I'm here, Tom.
Yeah, and I went in. But I was saying to them, like, Sunday night, I can't wait to go to work on Monday morning. I hate nothing more than a loss or a systems issue and the stress that it creates. But yeah, do you love your job?
Yeah, I do.
Yeah.
I do.
How's he going to answer that? He's going to say,
I'm tired.
I mean, Adidas.
By the way, did you hear him
Adidas
pause? So
watches.
you young people looking for a job, come work at NYSE. We love it.
Yeah, but
We
you
love
get
it
these
here.
great socks at Nasdaq. So.
You know, it's
Adita
like when I used to
Friedman.
wrestle, you know, and I'd win all my matches, and it's like going up against you and wrestling. You know, I need some real competition, so it's getting boring.
Want to wrestle?
I don't want to play baseball either.
I have a topic that I know we all agree on, and that is the problem that we're seeing from trading of overpriced stocks, as I call them, not overpriced because of their value, but the lack of splits in our market is truly impacting. When we hear about market problems, you got to get granular nowadays to see, well, what challenges are some of these buy sides having with some of the individual stocks they're trading. These high-priced stocks that refuse to split are, you know, the evidence is in the spread and how people trade them. Investors are not better off because someone is keeping their stock from splitting. And we're seeing the data, and there's more and more studies that are being worked on here because this is, you know, one guy in Omaha says, don't split your stock. We should ignore all investors except those that buy and hold. Well, guess what? Some people have to pay for college, and they have to sell the stock, and they're losing money because he refuses to split his stock. So that Berkshire effect has spread throughout our market, and it's creating a real problem. Ironically, we all talk about market structure, but these high-priced stocks are causing bad outcomes for investors. Do we agree?
What he said.
Well, ICE split. Did you guys split?
Yeah, we split
Yeah,
5 for
split.
1. We split 5 for 1 for that exact reason. There's also a body of evidence that Professor Angel is here in the first row pointed out. There's a body of evidence that stocks trade best between roughly 20 and 80. It's different studies give you different numbers, but tightest spreads.
We might have to split again.
That's a good thing, yeah. You touched on policy a little bit. So what would you like to see, some major changes in policy? And with the new chairman at the SEC, what are you expecting?
One thing I'm personally concerned about is we're building this industry-wide repository called the CAT, the Consolidated Audit Trail, and it's meant to include the personally identifying information of everyone who trades a security, including, you know, your 9-year-old daughter who has a 529 plan and a few securities in it. It would include her social security number and all of her private details. And the SEC ordered the exchanges to create this consolidated audit trail and create a repository that likely will have more personal information than any other repository that exists anywhere else in the world, and people will, thousands of people will have access to that consolidated audit trail. I'm concerned about that, both because the authorized people will have access to it, but also potentially unauthorized access, and it's creating a significant cyber risk. So that's one policy area that is keeping me up at night, and I'm hopeful that cooler heads prevail and we come to a different decision as an industry.
Yeah, so the question around that is, will the benefits of that, including costs of the industry, outweigh the benefits of actually implementing this? So the downside versus the upside, which I'm not sure.
Well, that's the problem is the process that was used to create CAT was a process that typically isn't used. It wasn't an SEC proposal with a comment period, and then we all talked about this industry instrument that the SEC was creating. The SEC wrote rules to make us create it, and it was really in response to the flash crash when people were putting together data on what happened, and it just took too long. So the reasons for CAT aren't really there anymore when you think about CAT and the benefit that we're getting versus what we have today in terms of surveillance. There's this notion sometimes on Capitol Hill when you talk about Consolidated Audit Trail that they think the Consolidated Audit Trail is this new surveillance mechanism. It doesn't surveil anything. It's a database, actually. And the surveillance we have today is much more improved. We have a complete database of both options and equities. It's all the things that are going into CAT. So we're building this separate repository, and we're jamming in personal information, as Tom pointed out, and we're saying, you know what, well, we're going to put it in the cloud, and best of luck to us all. So the benefits are tiny, as I think about it. In fact, I would argue the current construct of the CAT sets us back on surveillance when it's launched. This is not a statement about thesis, that they're doing exactly what the exchanges told them to do, but it's not harmonized data. And today, we're all using harmonized data to surveil, and it makes surveillance much easier. The CAT was built as just a complete database, and we were dictated what fields were put into the CAT, and we created this, this giant database that now we're going to have to figure out how to harmonize in order to surveil. So CAT actually sets us back when it comes to surveillance. So the benefit, I'm not seeing any benefit. I'm seeing a detriment as a result of formation of CAT.
And to be fair, the CAT was designed originally before Sony, Target, Home Depot, Yahoo, Equifax, or if you look at the federal government, the NSA, and most recently the SEC, were all the subject of major hacks.
With that, let me open it up to the audience for questions. And if you can come up to the mics on the sides, we'd also appreciate if you can keep the questions brief. That way we can get several questions answered. The mics are over there.
We don't have to keep our answers brief, though. Right?
I am jealous.
Yeah, go ahead, please.
Hi, I had a quick question. I hadn't heard any comments yet on the ICO market. We talked a little bit about IPOs, but obviously ICOs and crowdfunding eat into all three of your businesses. I know CNBC recently released some numbers. ICO offerings year to date, over 100, nearly $1.5 billion raised. Is there comments there about the regulations in place and to your previous points about going back to the regulators about what's going on, or is there a way to partner with what's going on in the ICO space? Thank you.
I mean, I think those initial coin offerings and the whole cryptocurrency space is super unregulated, wild, wild west. It's an interesting concept. I think that collectively, I know that Nasdaq can bring some regulatory prowess and technology to that process, but there are going to be a lot of millennials that are hurt by the notion of trying to get into Ripple, Bitcoin, et cetera, and trying to make a quick buck. But it's a super unregulated, risky area that I think needs regulation, needs technology, needs some kind of governance around it.
Yeah, go ahead.
I was just going to answer the ICOs. You could take Bitcoin, put Bitcoin in or crypto in or out. It doesn't matter, whatever form of currency. What they were doing were not within the bounds of the 33 Act. And so it doesn't matter that they were using a cryptocurrency for the ICOs. It matters that the disclosures that they were using to raise private funds was not within the bounds of how we do it under the law. So even though they were going out to a small number of investors, it was going viral, and they were actually touching more and more investors. So it has nothing to, it's interesting, there's a lot of news around it because it's crypto, but what they were doing, if they were taking US dollars, it was a problem. It wasn't just because it was crypto. Crypto made it a little easier.
Yeah, and just because implicit your question was that this is eating into our business models. I think you said that there's been $1.5 billion raised in total. We'll raise $1.5 billion next week in IPOs, and probably $4 billion if you had follow-ons. And these are companies that most of them would never go public. So this is not, we're not coming at this from a conflicted place. I share a lot of the concerns. It's going to end in tears for most of the investors. And there's a lot of threshold questions that haven't been answered. And what these companies are doing is they're saying, hey, I'm creating a new coin. It's Farley coin, and I'm building an airplane. And if you buy this coin, that'll buy you tickets on the airplane. As we all know, and as I know from being with great entrepreneurs, they do IPOs in the New York Stock Exchange, your business never ends up being what you think it's going to be. It always morphs over time. And so there's some very basic questions about, well, what about when the airline that you're building becomes an entirely different business? And people are going to be holding these coins saying, well, wait a minute, where did the value go?
Good point.
Yes.
Thank you. with the benefit of now 10 or 12 years of experience with Reg NMS, that regulation has come under a lot more scrutiny. And I remember last year at this event, I was very impressed with your panel, gentlemen, and posed the possibility of maybe daydreaming a little bit and thinking that the SEC might authorize a pilot program to allow issuers of listed securities to suspend unlisted trading privileges to allow all market trading to aggregate on a single listing platform. Lo and behold, on Friday, the Treasury released its massive capital markets study, and one of the many, many recommendations in it suggests that that is a valid idea, that UTPs could be suspended by issuers for mid-cap and small-cap listed companies. If it's good for small-cap and mid-cap, why should it not also be good for large-cap and also for ETFs?
I think the reason that we believe in the idea is because of the small and mid-sized companies and the lack of liquidity. But you have to look across the whole spectrum of why that is. I mean, there's a lot of fragmentation, a lot of different venues, a lot of dark pools. And the effect of those on a Bank of America or on a very liquid stock is very different than a small mid-sized security. So that's why we're focused on the small and mid-sized companies and saying let's use that vehicle to gather liquidity because you take the fragmentation out of the equation by doing that. And that's why I think it's a good idea there. As far as ETFs, there's probably a lot of things we can do. And for the less liquid ETFs to get them going, I think that would also be an excellent, good idea to use for the smaller new ETFs.
I do think we need to approach our market differently based on large cap, small cap, mid cap. We've always, the history of our markets was we treated IPOs differently as they came to market. In fact, the old UTP rule, you didn't UTP for several days after an IPO. But if you look at how our market performs at the most liquid, call it the top 100 ETFs and the top 100 corporates, it's probably the best market in the world in terms of efficiency. For the buy side, they rarely complain about what they can get done in the top 100. For retail, they're inside the spread. They're getting the best stats you can find in any asset class. So we do a great job on the majority of our notional volume, but we talk about the small cap and mid cap because they're a challenge for the buy side and for retail at times, but retail obviously has it pretty good across the spectrum. So when I think about what we need to do going forward, it's not a bunch of pilots. It's hey, let's approach our market based on the liquidity characteristics of the stocks that we're trading, not this one size fits all. That's the real problem. And if you talk to anyone who's complaining about our market structure, that's the root of the problem.
Little stocks don't trade a lot, and it's not worth a market maker's time to stitch back together the prices from 52 different venues and make sure it's really great, tight pricing at all points in time, whereas Bank of America stock, it is worth it. The kernel of the idea is a good one in the Treasury report, but I kind of read it quizzically because there's these 50-plus venues, and the reports said, well, yeah, maybe you wouldn't have UTP, but you'd still allow it to trade via brokers, which could imply, on the other 40 venues. So
Doesn't solve it.
Yeah, we'd really have to see the implementation here. Because if you just say, okay, Tom, you can trade an NYSE stock, but these two can't, but everyone else in the world can, you haven't solved the problem, and you've just cut these guys out. As much as I would love to do that,
Yeah.
I'd have a hard time arguing it was
You
good
got to solve the
policy.
liquidity problem.
Yeah.
Exactly.
Hi. Parallel with the question that was just asked pertaining to the Treasury report on Friday. The last time I saw the three of you together was House Financial Services, and you had some strong comments regarding maker-taker pricing and rebates. In light of Friday's report, can you give us some updated information about where you see maker-taker pricing in the next couple of years?
I think Friday's report, correct me if I'm wrong, I only read it one time, 230 pages. Friday's report, as it relates to access fees, I think raises caution to the implementation of a pilot. And as I testified, Nasdaq testified, it's not about the remove fee, it's about the rebate And as Chris alluded to, it's the structure of those securities. What kind of rebate do you need to liquefy that security? And you can't just say, an access fee of 30 mils is a bad thing, we got to take it down, because you're looking at the wrong side of the equation. And that's what I've been trying to change the argument on. Not sure if we're being successful yet, but we will hurt small and mid-sized companies and could even affect the larger companies if we implement a program that's not implemented in the correct way. And at the same time, the Treasury report, I think, also points to payment for order flow. We've got to take a look at both listed exchanges and ATSs, rebates and payment for order flow when you look at the access fees. Tell me if I read it wrong.
Yeah, by and large, I agree. There's lots of different pricing models for different markets. In futures, both sides pay a fee, and bonds, one side pays the whole fee, and equities, by and large, one side gets remunerated, and the other side pays more than that remuneration to create a net fee. So different fees work for different markets. If I could kind of snap my fingers in a perfect world, I'd rather not have maker-taker pricing in the equities world. But if you just did that in a vacuum, that is a very big problem. And all of the negative consequences that Tom just talked about would occur in this market. It would push lots more business off exchanges. It would be far more fragmented. You have more off-exchange venues, and it would reduce confidence. But most importantly, the market makers who are currently receiving a rebate would pull away from the market. So if you're going to do that, you have to do it very thoughtfully, and you have to take into account a number of other market structure elements that exist today.
I'll just add, I keep coming back to the question, what are we solving for? So when I read the report, it was a litany of ideas that we've probably all talked about around market structure, but there was no concise, we're solving for this one issue in our market structure, and that's why we're going to do these 10 things. The debate around maker-taker, I don't know if it's a conflict debate because someone's upset that they don't know where their orders were routed to, because I know there's an easy solution for that. And it was incorporated, ironically, in the Treasury report of added disclosure for institutional investors. There's always going to be conflicts in our market. Whether a broker-dealer sends an order to a dark pool, that's a big conflict, especially when he owns the dark pool. That's going to exist in a ban on maker-takers, whatever you want to call it. Or if there's discounts on fees at an exchange, there's going to be a conflict. We're always going to have some discounts for some of our largest clients. So we're not going to solve a conflict issue. So if you think there's a market structure issue caused by maker-taker, prove it to me. We reward market makers for hanging prices out in our markets last in line because most orders are hitting dark pools because they're cheaper. So there's a reward for that market maker to hang his price out. And by the way, the statistics are pretty freaking impressive. The spreads that our traders are getting are phenomenal. So are we going to take that away because someone has a notion of a conflict and they think the market will be better? I need to see why in Bank of America there's a problem with how we treat that market today. It's one of the most efficient markets I've seen. So tell me why we need to change that, and I'll try and find those solutions. But
Concannon calls market pretty freaking impressive. I think that's going to be the headline.
Icky.
Yeah.
Yes, please.
Thank you. Thanks for your presentation. My name is Dee Young. Currently, the stock market and the corporation, they are really sort of in the same direction. The corporation, they don't really do the good business. What I mean is maybe just provide a negative service.
Tom's
Just
Corporation?
think the brokerage, they don't really do the transaction of the stock market, but they have done a lot of damage about a fair market mechanism. I just wonder if your stock exchange can provide better mechanism to penalize those brokers who team up with corporation and who team up with a government agency. Actually, the small business or consumers are really victimized. I just wonder if you can make a better mechanism to resolve the problem rather than an individual or small business have to fight for the big agencies and the big corporations and big government.
Well, You're talking to the right person.
I think Tom has been studying this issue, and he has the answer.
I definitely do.
I'm very much a law and order person, and the New York Stock Exchange, we have a regulatory team of over 100 people, and I was raised by a woman who was a Catholic nun for 5 years and left Georgetown Visitation the night before her final vows, and my father's a federal judge, and so in my house, if you did something wrong, you were either struck down by God or the law. And so if there are those wrongdoers, we'll find them. And yes, the answer is yes. We will follow up on it with our regulatory staff.
Thank you.
Thank you.
How you guys doing? Steve Cohn from Salt Lake Technologies out of California. I guess this is more a question for Farley and Chris. I've spoken with Adina, so I kind of know what Nasdaq is doing. What are you guys doing in terms of big data and analytics? You referred a little bit to consolidated audit trail, but I know that it's a way, taking all this data of how you can structure new products to go out and sell, just like what Nasdaq is doing. I'm sorry to, put Nasdaq ahead, but I mean, I just don't know.
No, you're
what,
right. You're
what
absolutely
New York
right.
is doing, and certainly what
So, guys, catch
CBOE
up a
is
little
doing.
bit.
Tom,
Yeah.
I knew you'd appreciate that.
Yeah, that's good.
Well, Tom just bought a big company that has a lot of data in it on debt, right?
Yeah, so, I mean, the answer is we want to be the provider of big data. Are we good at ingesting it and using it for our own purposes? Of course. Otherwise, we wouldn't be able to process 50 billion messages. But our emphasis is more being able to provide lots and lots of data. So, for example, we spent $5.2 billion, and we bought a business called IDC that is the single largest provider of pricing data for bonds. We're also a significant pricing provider for the futures markets and the equities markets. And we have found where in some ways it's a hedge. As it gets more difficult to operate, say, our equities trading business in this fragmented world, the data becomes more valuable. And that's playing out in bonds, whether it's prices or reference data or futures markets. People, as the markets become more fragmented and opaque, they more and more need very high quality data.
Thanks, guys. Appreciate it.
I'm Dave Michaels with the Wall Street Journal.
And Hoya.
And Hoya, twice. You guys continue to be pretty negative about the consolidated audit trail. And I believe in about a month. In about a month, you're due to report to the CAT on November 15th. So are you formally petitioning the SEC to delay the November 15th deadline? If so, when will we see a proposal? And do you expect the commission to approve it?
So there's no formal petition. That's not how it would work. Obviously, we're expressing concerns, broader concerns about the consolidated audit trail and its readiness when it comes to cyber issues, networking issues, and also the industry readiness, both our readiness to put data in as well as, at a later date, the brokers have to put data in. So all of that is actively being discussed among us and obviously among the SEC when we come to any conclusions on where we think our readiness is.
How is it done then, Chris, if it's not done through, isn't it an NMS
I'm just trying
committee?
to avoid the question, actually.
I hesitate to say this. I'm going to sound like a fool in my old university here. I actually don't know the mechanic. Do you know the actual mechanic of how?
I don't.
Yeah.
No, the SEC, right now we're under SEC rule to have everything delivered by November 15th.
So I don't think
it's
there's a
really in
petition.
the SEC's hands to change that date and make sure that it's delivered in an appropriate manner. Look, we're not missing surveillance right now that we need to stick CAT in and suddenly we're going to have the better surveillance. So why be reckless with our data, right? Before PII goes in, we're still putting our members' trading data in, and that has certain privileges that we don't want to show the world because it's identified by every firm and even more granular than that. So we need to be very protective of this data, and I think the SEC has the same view. But it's a dialogue. It's not anything formal.
Yeah, and I'm not avoiding the question. I truly just don't know the actual mechanic, but I'm pretty sure it's just the SEC would agree to delay. But that's not where I personally have been focused my time. Some of my colleagues have been, working on will it be implemented on time or delayed. Where I've been spending my time, and you've been with me once or twice, whether it's with Congress or then privately with the SEC, is just on the structure of it. Forget about a delay. Do we want to have this audit trail with the personally identifiable information for everybody that trades in the equity markets, even 10 years from now? And I'm suggesting we don't. And so in the New York Stock Exchange is suggesting we don't. And that's where we've been putting the majority of our effort.
And we're going to have Commissioner Piowar here later this afternoon. We can ask him the same questions.
That's a great question for him.
We will let them know, as they already do, what's the exchange viewpoint on this. Right. Very clear.
Thanks. Ben Bain with Bloomberg News. Another SEC somewhat related question. The Chicago Stock Exchange proposed sale, it's really the one exchange out there right now that I guess kind of remains independent of the big guys. Do you all have a viewpoint on the proposal at all for the Chinese conglomerate led bid?
Chris?
Should it go forward?
I called Tom and asked him to buy it just to make this issue go away, and I got the wrong Tom. I called that Tom.
And you're in Chicago. So.
Look, I don't know any details about the buyer. I don't know what the politics are involved. So I can't tell you. I can form an opinion on who should buy the Chicago Stock Exchange. I do know it. When I look at the Chicago Stock Exchange and I think about Reg NMS, I think that's one of the problems with Reg NMS is we're giving protection to someone who's like 0.02 market share, and there's this great privilege with that exchange license, and that's why someone wants to buy it. And we've created value for something when it's not providing similar value to the market in terms of liquidity and all those other things. So I have more of a problem with the market structure than the buyer.
Yes, same. We haven't been able to learn much about the buyer, so we don't really know enough to form a position one way or the other. We haven't lobbied on it or spoken to the SEC about it one way or the other, to my knowledge.
We welcome competition, so whoever it is, whatever it is fine. I think that's a decision that the SEC is going to have to make.
Thanks.
Well, last question.
First of all, I'd like to thank you guys all for coming down and speaking to us, and especially to Mr. Farley for speaking with our Baker Scholars this morning. And so you guys touched a little bit on regulation and the effect it has on listings. Can you talk a little bit more about mergers and acquisitions and the effects of policy within that area on IPOs and listings on your exchanges?
Yeah, I think that's a really good question. So I talked earlier about number of listed companies down by 40%, market cap up by 3 times, and so the average company is 5 times bigger. A lot of that is just a basic rule of kind of economics. It started with Sarbanes-Oxley in earnest. We started layering cost and regulatory burden on companies for very good reason. It wasn't, Sarbanes-Oxley passed the Senate 98-0. So this, it wasn't a spurious set of regulations, but it started to put real cost. That cost has increased over time. It created something called the PCAOB that oversees the accounting bodies, and they have expanded the scope and regulatory burden attendant to Sarbanes-Oxley over time. And then it picked up speed and momentum under Dodd-Frank. And we've created more cost and complexity. And the third rail has been running that entire time, which is more legal risk, greater number of frivolous shareholder class action lawsuits, more politically motivated state attorneys general. So when you add all three of those together, what do you get? It's really expensive to be a single public company. Well, what's one way you deal with that? You put 2 public companies together, and you only have the cost 1 time. Or maybe it's 1.1 times, but it's not 2 times. And so that's one of the reasons why we're seeing the companies get bigger and bigger and bigger. And that in and of itself, you might argue, well, that's not a bad thing. Bigger companies tend to be a little bit safer to invest in. But I would say it is a bad thing. I think this country is all about small, mid-sized businesses and the innovation therein. And I don't want to see a world where you really don't have a choice but to be AT&T. I want to see a world where you have a choice to be a small, scrappy, innovative competitor to AT&T.
Please join me in thanking our wonderful panelists here.
Well done.